Okay, in this video, let us discuss this stock CAMS. Nice setup on the right hand side, very tight setup, as you can see here. Almost 8 points in the base. However, I have chosen to reject the stock, and I will explain to you the reason why. Okay, the parameters look interesting. These are my notes, but I will explain this to you one by one on MarketSmith website, not here. But I want you to look at this base, extremely interesting base. Number one, let's have a look at the moving averages. Why did this stock come onto my radar? See, the 50-day moving average is above the 150-day and the 150-day is above the 200-day. So it is a strong stage 2 uptrending stock. Next, it has minimum 10 candles in the base. Next, it is forming a tight consolidation pattern. See, 1, 2, 3, 4, 5, 6, 7. So next day, if there is a baby candle or an inside candle after this, the setup becomes even more powerful. Okay. So the setup is excellent. I mean, getting 8 points in the base where I require minimum 4 points is like icing on the cake. Okay. 8 points means 4 contractions in the base. So next day, if there is a baby candle or the inside bar, next day the setup becomes extremely powerful. And as you can see, price is contracting and the volume is also contracting. So this is a classic volatility contraction pattern described in Mark Minervini's book, Trade Like a Stock Market Wizard or Think and Trade Like a Champion. Those two books are the books that I recommend to you, highly recommended. Read each of those books at least 3 times with a gap of 3 months each. Your trading skills will significantly improve. Okay. So the setup looks good. It's very tight price action. Volume is declining. That means the supply is reducing. The stronger players are snatching away the stock from the weaker players. And it is in a strong stage 2 uptrend. Now let us go to MarketSmith and start looking at the parameters of the stock, the technical, the fundamentals, and things like that. Okay. So let me go to CAMS. So basically, this business is a service provider to the mutual fund business. So let me open this. I click on consolidated here. Now have a look at this nice run here. It's a nice stage 2 uptrending stock consolidating further. If I click here, it says pattern consolidation stage 2. So this is base number 2. So this is very early in the stage 2 uptrend. This is early stage in a stage 2 uptrend. See how the volume is declining. So the setup looks perfect. Okay, there is no problem with the setup. Let's come to the parameters. Fundamentals: increasing quarterly earnings per share growth. Okay, sorry, accelerating EPS growth. Okay, accelerating sales growth. Fundamentals look perfect. The problem is this: group rank. Group rank is 80, which means it is not in the top 20 percentile. EPS rating is fine. Master score should be above 60. That is fine. Price strength is a problem. Group rank is a problem. And I will tell you more about the group rank because the group rank has actually been declining since the past 6 months, which is not a good sign. Institutional demand is there. Return on equity is fine. Cash flow is positive. The PE ratio is on the higher end of the range. That is positive. Earnings stability is low, which means stability number is low means stability is high. And 3 to 5 year CAGR EPS is fantastic. Okay. So if we scroll down, you see there is only one or two quarters only where the earnings growth has been poor. But all in all, fundamentals look excellent. Accelerating earnings growth, accelerating sales growth on a quarterly basis. Okay. Management ownership is not there. That's okay. This company might be owned by mutual funds because the funds are this company provides services to other funds. Okay. Look at this 21, 29, 26, 35, 42, 58. This is earnings per share. Okay. So you can clearly see an increasing, the trend is increasing. Everything looks okay except two things: price strength ranking and industry group rank. But these are important points. I don't want the relative strength ranking to be near 70. I want it more than 80 or preferably more than 90. That is what the best growth stocks uh, display before they make their big moves. I'm not saying that this stock cannot go up. Well, of course, it can go up. However, the upside could be limited because the stocks that go up very fast are the ones that have very strong relative strength, like 80, 85, 90, 95. Those kinds of relative strength is what is displayed by the best of the best stocks. The what I like about this stock is the volatility contraction. The volume is contracting, the price is contracting. Okay. Now let's come to the rejection reason. One thing I don't like is the price strength ranking, this number. That's what I don't like. Another thing that I don't like is industry rank. Now, I could have still taken the trade with 72 price strength and 80 group rank. However, if we look at industry groups, now this belongs to finance investment management sector. So let's go to finance investment management sector. See, this is finance investment management. Now, if I look at this 6 months ago, the rank was 24. So it was one of the top ranked industries. 3 months ago, the rank went beyond 40. That means it started to decrease. Last week it was 68. Now it is 80. That means the rank has been continuously rising, which means the performance of the industry is becoming poor and poor. Okay. And there are 170 stocks. So it is not just one or two stocks that are pulling the industry down. It is a collectively stocks in the investment management business are pulling the industry down. And as William O'Neill says, 50% of the move of a stock is attributable to the industry group strength. So if this stock has to go up, it is not going to have that 50% support from the industry. Moreover, so this is one negative point. So if the stock had relative strength of 90, I would have ignored this. Okay. Or if this was rising, like for example, it went from 150 to 80. Okay. So the rank is actually improving. Then I would have taken a position in the stock. But since price strength is also poor and industry rank is also declining, I don't find it much convincing. Okay. Just because there is a volatility contraction pattern doesn't mean that we have to take a trade. Now let's go to the industry. See, these are the stocks. If we see where is this company? 1, 2, 3, 4, 5, 6, 7, 8, 9. It is ranked ninth within the industry in terms of market capitalization. Okay. Now, in terms of EPS rank, if you see in terms of EPS rank, it's not even close. Sorry. In terms of EPS rank, there are other companies in the investment management business which have a far better EPS rank than this. In terms of price rank, there are a lot of companies which are above this. Okay. In terms of buyer demand, again, a lot of companies above this. So clearly, this stock is not a leader in terms of uh, earnings rank, price rank, institutional demand, or even master score. This stock doesn't seem to be the leader in the particular industry, not in terms of market cap, not in terms of sales, because it is just a service provider. So when I look at all of these factors, my confidence goes down. I wouldn't want to put my money into this stock when there are other stocks which are displaying far superior price relative strength and have earnings even powerful than this. Okay, there are 2 3 stocks right now which I won't name here because I don't make recommendations, but the point is there are 2 3 stocks right now which have far better price relative strength, far better, even double the earnings growth rate and sales growth rate than this stock. So if I have better stocks on my watch list for tomorrow, on my radar for tomorrow, why should I pay attention to this stock? Maybe I should give it one more quarter and then see how it does, then see the industry performance, and then come back to this stock. Because if this stock has to go up, if this stock has to double, it will continue to form basis in between, and I will keep an eye on this stock. But currently, I am not interested. Okay, even though the setup and everything looks good, just for that 10-20% gain, I wouldn't risk my capital here, because generally my stop loss is 8%, and I gradually move my stop loss. 8% is my initial stop loss. So I wouldn't take that risk. I have other stocks where I'm better off investing my money there. So that is why I am rejecting this stock. Please like, comment, and share this video so that this kind of analysis, this kind of information reaches those who truly want to become professional stock traders in the long run. In these videos, I am discussing the technical factors and the fundamental factors as well, plus the ratings that MarketSmith is giving us. Okay, this is like a holistic 360-degree analysis of a stock that is required to do before we buy a stock. After we buy a stock, then we go into the subject of trade management, where we have to really dig deeper into the company financials to see how the company is actually doing. Are the margins improving and things like that? So for example, if we look at this, if we just scroll down, okay, see after tax margin. So 2012, the after tax margin was 18.53. Now it is 30.88. That's an improvement in margin. That's a good sign. Okay, even from previous year, the margin seems to have improved. That's a good sign. So margin expansion is a good sign. Okay, earnings growth, sales growth, high relative strength, improving industry rank, those are all good signs. Those are the things that we need to see before we buy the stock. After we buy the stock, we dig deeper into the fundamentals of the company. Is the company improving? Can the fundamental measurements, are they will they continue to improve? Okay, if the answer to that question is yes, reasonably for the next 2-3 quarters, then we hang in there with the stock. But if we don't have confidence, okay, then we should take that double digit return and get out of the stock. That is the subject of trade management, which I will cover in some other videos. But for now, I am rejecting this stock. Thank you so much.